What is going on, guys? It is Smart Money Source here, and today I want to give you the last explanation you will ever need to do a proper and detailed multi-timeframe top-down analysis. This applies to any market and it involves market structure, liquidity, and ranges. What is the main problem most traders have when trying to do a proper top-down analysis mixing market structure and liquidity? The time frame difference. We're going to have multi-timeframe structures and multi-timeframe liquidity pools that are going to be playing together, creating a story that is difficult at the beginning to understand. So that's why it's important to have a set of rules or a guide in order to do it properly. So when we are looking at the chart, we are probably going to see something like this happening. For example, we have this move to the upside, then we have a clear break, and then price, boom, comes back down here, taking out these lows here, which was the origin of this last break of market structure, and then price continue going higher. And we're going to think, okay, this was liquidity. But what if price does something like this now? Boom, comes back down, taking out this low, and then breaks again to the upside, and from then continue going higher. This is because market structure currently is in a consolidation period. You know, if you watch any of my previous videos, if you haven't, I recommend you to go over my playlist with organized teachings. But to summarize, there are two types of market structure: the normal market structure, where price is making higher highs and higher lows, and the consolidation, where price is going to stop hands over and over again because they are accumulating orders before pushing higher or pushing lower. So knowing that, we are going to anticipate that when we are on consolidation, we can expect these liquidity graphs to happen. Let's say that we are on a bullish trend and price is making higher highs and higher lows. So every time price makes a new higher high, we identify this last level as the last higher low. So we are going to anticipate if price retraces to this level, potentially long, right? But what is the problem? Without knowing what's the higher time frame telling us, then we are going to probably end up taking bad trades because maybe price breaks before continuing higher, or maybe it breaks and then continues going lower. And a way to anticipate this is by looking at the higher time frame. So let's say that this is a 1 hour chart, and now in this 1 hour chart, we're going to add the information of a daily trend that looks like this. And price is now pushing higher. What is this telling us? That now the daily is in a bearish move because the last break of market structure happened to the downside, meaning that the origin of this break of market structure was this last lower high here. And inside of this lower high, we are probably going to have a distribution or an order block, doesn't matter. The thing is that we are expecting price to continue this bearish move. If we are expecting that to happen, then why would we look for longs here? In this scenario, we should anticipate that price is going to break this low here, this 1 hour structure. Okay, why? Because we are coming from a higher time frame level, and it is always more important because of the fact that price takes more time to develop or accumulate orders on a higher time frame compared to a lower time frame structure. So if we come from a bearish structure on a higher time frame and price is retracing into our point of interest or an order block on a 1 hour, then we shouldn't expect this to hold, or at least the chances of this holding are lower compared to breaking to a downside. So what happens if we add another layer of information? Let's say that we have now a monthly chart that looks like this. We have a move to the upside, then price retrace, then makes another impulse to the upside, and then retrace one more time. Now this is the monthly chart. And what can we see on the monthly chart? The price is bullish. The last break of market structure was to the upside, meaning that we have a bullish intention to continue going higher. And on the daily chart, we have a retracement into a bullish order block or a bullish accumulation, basically the last higher low on the monthly. Now price on the daily is coming from this level, meaning that this 1 hour trend has as target potentially this high here. So in this case, when price does retrace into this 1 hour order block, then it's very likely that it's going to hold and continue pushing higher. So in conclusion, each trend is going to have a target, and until that target isn't met, price is going to continue respecting the order blocks, the voids, and any bullish discount level that we can find in the chart. So in this case, the 1 hour trend that we have here, the target is likely going to be this daily high because of the fact the price is hitting this level. This downtrend on the daily is likely to have as target this order block because price is retracing from a bullish move on the monthly. Let's say that we have another trend here. Let's say that we have a 6-month chart that looks like this. Now this blue line is a 6-month chart, and you can see adding this new information, now it changes again the story because price is on a bearish trend on the daily. We are hitting a bearish level on the daily, and price is coming from now a 6-month bearish level. That means that the monthly chart is now aligned with the daily chart, and now potentially we are going to see a break on market structure on the 1 hour to be aligned with the daily and the monthly. And what do you think is going to be the target of a bearish move to a downside on the monthly if we have the last lower low on the 6-month chart down here? Well, if we are on a bearish trend and price is hitting the last lower high or the last level where smart money distributed, then the next logical move is going to be to take out this low that we have down here. And the reason is because of liquidity. And now I want to touch this topic about liquidity, which is very simple. You probably know it already, but just in case. Every time we have an uptrend or a downtrend, doesn't matter, price is pushing higher, right? This move to the upside is going to be inside of a higher time frame structure. Let's say that we have a bearish structure or a bullish structure like this, okay? And price has just made a higher high. Why is there a retracement going lower and then after the retracement price go higher? It's not because the market structure likes to make higher lows and likes to make lower highs. No, there are two main reasons. The first reason and the most important one is that smart money is going to have orders here that needs to be mitigated. Mitigation means that if smart money is sold to buy down here, basically they created an order block, they're going to have some orders that are in drawdown, and to have a clean and profitable book, they are going to come back to close those orders in drawdown, those shorts, and then continue buying to push price higher one more time, creating another order block at this level. This is one reason of why price comes back down. The other reason is that we have internal liquidity. Every time price is on a range, and the range can be marked as the last higher high in this case and the last higher low, basically where is the most recent break of market structure and where was that break of market structure originated. If we have this as a new higher high, then the last higher low or the last origin of this move was down here, okay? So when price is retracing, all these lows that we have here are going to be internal liquidity. Internal because it is inside of the range from the last higher low to the last higher high. So below each one of these lows, there are going to be sell stops from people who is shorting when price break out of this bullish trend, and people who has been buying and placing the stop loss below this level. You know that the stop loss of a long is a short, basically a sell stop. So that's the only reason of why price moved lower, because it wants to grab liquidity below each one of these lows, and these sell stops are going to be paired with longs or buy limits from smart money. So you can see there are two main things here: the mitigation of the order block and the grab of liquidity below each one of these lows. And it is the same for a downtrend, but obviously inverted. And why price does make higher highs now? The main reason of why price makes high high is because above this high, there are going to be buy stops in this case, because we are on a bullish trend. Why? There are breakout traders that are going to be buying above this high, and there are going to be sellers within this move to a downside that are going to be placing the stop loss here. And the stop loss of a short is obviously a long or a buy stops. So you can see how smart money comes back down to a discount level where they previously accumulated orders and they have orders in drawdown. They mitigate those orders, they accumulate one more time, and then push higher in a level where they have enough liquidity to close in profits the long that they have recently accumulated, and to add more shorts if they want to make another retracement. So having this in mind, now how can we mix liquidity with market structure? Let's take a look at an example. Let's say that we have a bearish trend like this on the weekly chart, and inside of this last push down, we're going to have a daily trend that looks like this. And now we have a retracement of the daily down move on the 1 hour chart that looks like this, okay? So what can we tell about this market structure? We can see that price is obviously on a bearish trend. The last lower high on the daily was this one. The last lower low was this one. And now price on the 1 hour has broken the structure. Let's say that this is the 1 hour structure and we have a break on market structure, and price is starting to move higher, making higher highs and higher lows on the 1 hour. What can we tell about this chart? That we are on a weekly retracement now. This weekly retracement has this as the last lower high on the daily. That means that we can expect this lower high to be broken or maybe not. How can we tell if price is going to respect this order block or not? Well, obviously, when we are looking at this weekly move to the upside, we're probably going to have a bearish order block like that, okay? Which is the main reason of why price is retracing. Remember, price wants to mitigate the orders that we have inside of this level. But at the same time, what do we see here? We have equal highs on the daily chart. are going to have enough liquidity for smart money to start distributing or accumulating shorts one more time. Analyzing only the market structure, it is very likely that this lower high on the daily is going to be respected, because we have, this was the last lower high and it's within the order block, okay? But if we add the extra layer of information, adding liquidity in this case, we can see that these are equal highs, and equal highs are going to have much more buy stops compared to an all high. So this 1 hour trend has as a target these equal highs. So we are not going to look for this as a reversal inside of this order block, but rather above this equal highs to grab the liquidity and then anticipating a break of market structure. Now let's frame another situation where we have a deep move to the downside on the daily chart. Then we have something like this, for example, and price is making lower lows and lower highs on the daily. What do we see here? Again, one more time, this is internal liquidity. Basically, any high, remember, inside of the range, the current range is from this low to this high, is going to be internal liquidity. So having this liquidity pool, we can anticipate that price is going to very likely run that liquidity before attempting to go lower, continuing the bearish move on the week chart. So basically any high that we have inside of the range is going to represent a liquidity pool. But what if we have something like this, for example? We have these lows like that. We know that these are equal highs here, and we have a lower high here. Can we expect this lower high to be broken? Well, let's say that we have efficient price action, and if you don't know what efficient is, it's basically the wicks of the candle touching each other. Basically there is no imbalance, and we have this lower high here on the daily with a deep move down. Inside of this daily move, we are going to see probably a liquidity void. We know that price is attracted to these levels to rebalance them. So in spite of having this high as an all high on the daily chart, we are anticipating the following setup: price running this liquidity pool, basically these equal highs, and then respecting this order block. Why? Because price action is efficient, we are within the main order block on the weekly chart, and there is no reason of why price might push higher. This lower high here is the test probably of the order block already, and given the fact that we don't have any kind of liquidity void or imbalance above this high, we can expect this level to hold. Similar situation where we have equal highs on the daily chart, liquidity, and we have a test here, efficient price action here, basically no inefficiency, no imbalance. The only imbalance that we can see is down up here. That means that price is likely to come back to rebalance this level, grab the liquidity, and then continue going lower, right? But what is the problem? The problem here is that we are not at a premium level. Remember, the main reason of why price retraces is to mitigate orders, and the order block is a little bit higher. In this case, this lower high or this order block with the void is likely to be broken because it's below the main order block where we know smart money has orders in drawdown. So it's the same scenario with the difference that this lower high is not touching this order block. So you can have efficient price action, but if we are not within a premium level, then you can expect price to simply break this level, touch the main order block, and then continue going lower. So in this case, this high is going to be seen as internal liquidity one more time. Now let's do a top-down analysis on EURUSD, applying all these concepts that you just learned to see what is the thought process in order to do this. We can see here we are on EURUSD on the monthly chart. If we see the overall picture, we are obviously and clearly bullish. Why? Because the most recent break of market structure was this one, meaning that price has intentions to continue going higher. Obviously, when we are talking about Forex, we know that the pairs tend to be in consolidation. So it's very likely that this high is not going to be broken for tens of years, or maybe never. It might never be broken. But well, just to give us an idea of where are the orders that need to be mitigated, where is the internal liquidity, we are going to say that price is now bullish because it has clearly broken to the upside. So now we have to ask ourselves, which was the origin of the break of market structure? The origin was down here. We have a consolidation where price accumulated orders and then broke to the upside, meaning that we are stuck in this range currently on the highest time frame, from this low here to this high. Anything within the range, remember, is internal range liquidity. What do we have? This low, an imbalance here, and an imbalance here. We can see a price has already taken liquidity below these lows, filled some of this imbalance, and now it seems like it's continuing going higher. So how can we interpret now this most recent price action following the same concept? Well, we have to ask ourselves, which was the most recent break of market structure now on a lower degree? Well, we have this as the most recent break of market structure. Price came to the main order block, which we can consider to be all this down move, where smart money sold to grab liquidity, accumulate at discount level, and then push back up. And now the price has hit this level, we have a break of market structure. That means that a new range is going to be this one, from this high here to this low. What do we have inside of this range? Internal range liquidity below each one of these monthly lows. We have a void here and an order block that need to be mitigated, and we can see a price already grabbed all that liquidity and mitigated the order block. That means that we have a new structure. Now let's move on to a weekly chart. We have this break of market structure and this most recent break of market structure. So we are going to talk about specifically this one. Price broke the structure to the upside, which was the origin. Down here, what do we have? A reaccumulation, order block, however you want to call it. That means that we are stuck in this range now, from this low to this high. But before we get into this last one, we have to understand that which is the target for this break of market structure. Well, if we are stuck in this range from this high to this low, that means that anything within this range high to this range low is going to be internal liquidity. So we can say that this high, these highs, any of these highs are going to be internal liquidity, and we can expect price to continue pushing higher to grab some of that liquidity and mitigate the main order block, which we can see here is this level, which was the last push up before going lower. Now, inside of this last range, from this low to this high, we can say that the target for this push is going to be this high. Price has already grabbed liquidity below each one of these lows, as we explained earlier, and now it's heading towards the external liquidity, which is going to be above this high. So we can say that this bullish trend is going to remain being bullish until at least we hit this target. And now on the most recent break of market structure, which was this one on the weekly, we can see that price is retracing to grab liquidity internally, and now which is the target? This high here, because this now represents the external range liquidity. Now, let's talk about the daily chart. We were on a bearish trend and price now is breaking the structure. This was the most recent break of market structure and the origin is down here. So we can say that this break of market structure has as a target the same target as the weekly, which is this one, the external range liquidity. Now the daily is in confluence and aligned with a higher time frame, which in this case was the weekly chart. So if this was the most recent break of market structure, that means that we are trapped inside of this weekly or this daily range from this low to this high. If we want to have a long-term buy, then we have to analyze what is internal liquidity and what is external liquidity. Below each one of these lows, we have internal liquidity, we have a void, and we have a lower time frame accumulation down here that needs to be mitigated. So now we have the two reasons of why price might retrace and where at one moment we are going to expect price to reverse into this level to grab liquidity and accumulate new orders. Where is this going to happen? Well, we can see that the price action here was very efficient. And we have a tiny little void here that was filled with this daily candle here, and price then broke the structure. So we can say that this candle, this distribution that we have here, is likely going to be the reason of why price is going to begin a retracement into this level. So pay attention to this level. If we have any break of market structure on the lower time frame, we are going to have a nice sell-off on EURUSD. Now to sum up how to do a proper top-down analysis, I want to quickly address these specific rules. Mark different time frames, market structure. Let's say that this is the 1 hour chart and this is the yellow one is the daily. So on the 1 hour chart, the most recent break of market structure happened here. And this market structure was originated on this low here, the last higher low. On the daily, this was the last lower high and this was the last lower low. That means that now we have a market structure and a range to play with. The range is going to be from this high to this low for the 1 hour chart and from this high to this low on the daily chart. After you have your structure, you need to mark where are your liquidity pools. Let's say that we have this downtrend on the 1 hour, meaning that every high that we have here is going to be internal liquidity and it's going to contain enough buy stops for small money to start accumulating short. And if we have equal highs, the same story. You have to mark all of them, which brings us to a third point. Set a target for each trend. We have a clear bullish trend on the 1 hour, and which do you think is going to be a target? We clearly have some all highs and the main order block, so the target could be hitting this order block and maybe this lower high that initiated this down move here. So we have as a target potentially this point of interest, which is inside of the order block, but most importantly, at least touching this order block right here. So this bullish move is going to continue being bullish until we hit this level. And then follow the trend and trade like smart money. If price is, for example, here and starts retracing to the downside, that means that we have a 1 hour break on market structure, meaning that we have a new structural point, which is this one, and we are going to likely be looking for longs down here because we have higher targets to be met. So price has no reason to break to the downside. And let's say that later price touches this level here and starts a lower time frame, maybe downtrend here. That means that the target is very likely going to be breaking this low here because price is now coming from a higher time frame bearish level. So set the targets, mark your liquidity, mark your structural points, and you're going to be much more profitable than before. I hope you loved this video, guys. Don't forget to subscribe and like to support the channel.